The stock market is risky. That's probably what you've been told your entire life. But here's the secret that most parents don't understand. The stock market has historically recovered from every major and minor crash that's ever happened. And personally, I've paid off $43,000 worth of debt and was able to use that momentum to build up a net worth that we just recently crossed $850,000. And guess what? Most of that net worth is sitting in the stock market. And I realized that for someone investing for decades, staying out of the market can actually be a bigger risk. So today, I want to show you why I think parents should be much less afraid of any sort of stock crashes or market turndowns and being more afraid of never getting invested in the first place. Let me know if you think this is you. When someone mentions the stock market, do you instantly think like, oh, if I put in $10, $20, $30,000 and the market drops 30%, that I've instantly just lost 30% of my dollars? And technically, yeah, you did, right? Technically you did on paper, but I think we have to change the strategy around why we were investing in the first place, because typically a lot of people look at investing on too short of a time frame and they get nervous because they don't understand how the whole thing works. If you're 35 years old, for example, and you're investing for your retirement, you might not need or should not need that money for another 20, 25, 30 years, right? So why are we evaluating a 30-year investment strategy based on what happens over the next 12 months or even the next 12 minutes? Guys, real quick, I've opened up some spots in my Wealthy Parent program for busy families looking to get more clarity in their finances, find extra money each month without making more so that they're able to put more of their hardworking money towards their financial goals and just feel like they're winning with their money. If that sounds interesting, any of that, there's a link below this video to book a call directly with me and we could start your path to becoming a wealthy parent. I'll see you there. Here's the secret. The stock market has a history of always recovering from major declines, right? So there was the Great Depression, the 1970s, basically the whole decade, Black Monday, the dot-com crash, the great financial crisis, and recently with the COVID pandemic. And in all of those situations, in the moment, it felt difficult. And I can only really speak about the pandemic and even some of the great financial crisis, but I was definitely very heavily involved in the pandemic and it felt heavy, especially if you turned on the news, you watched whatever news outlet you watch and you just heard all the doom and gloom that was going on and no one knew exactly what was going on. But the people who understood the stock market, guess what they were doing? They were buying more because they know that over a long enough time horizon, it's going to shoot right back up again and everything's going to be fine. Now, if you needed that money for 6 months from then, a year from then, that is understandable. That struggle is real. But if you're someone who's maybe my age, 30s, 40s, something like that, we don't need that money for a while, or at least we shouldn't. So this is where I think we actually need to redefine the risk, right? Because a lot of people think, a lot of parents think, what if I invest and the market instantly goes down? That's one type of risk. And I think we have to change the behavior on that. It's like, why did we start investing in the first place? If we are investing to make a short-term cash win or whatever, right? We're trying to win the lottery. We're trying to get those penny stocks or whatever everyone's doing. That's the wrong mindset. What I want you to think is about this risk. What if I don't invest and inflation slowly eats away at my money for the next 30 years? That's a super significant risk as well. Because if you keep, I don't know, let's use an extreme example, $100,000 in cash, and you're afraid of losing it to the stock market, over the next 20 years, the purchasing power of that money will basically just be significantly reduced. One of the biggest mistakes that parents make isn't picking the wrong stock. It's trying to time the market out of fear and out of misinformation and out of not just understanding the process at all. They'll say, I'll sell now to, avoid the crash. Drop a like on this video if that sounds like that's something that you've done in the past ever, and I'll get back in when things settle down. That's like when you're ignoring your friend or you don't hang out with your friend. It's like, let's hang out when things settle down. Like, when the kids are back at school. When this, right? It's the same thing. We all know it's just a lame excuse to keep kicking the can down the road. You're not going to see your friend Sally. Everyone knows it except for Sally. But historical data, the real raw numbers, actually show us that this is a mathematical disaster. So let me pull up a survey done by firms like JP Morgan, for example. So this is a chart here. Impact of time out of market. So this is basically showing if you were to make a $10,000 investment, it says down here, between January 1st, 2004 and the end of 2023, so basically 20 years in the S&P 500, which is kind of like the gold standard for investing in the United States. It's just the top 500 companies in the US stock market, and they kind of just keep rotating in and out, like the top ones stay and everyone kind of rotates out. If you were to invest that $10,000 and you were fully invested for those 20 years and you didn't add any other, you didn't contribute any extra money, that would come out to a 9.7% return, getting you $63,000, right? If you missed the 10 best days over those 20 years. Now, let me do the quick math here as we're talking this out, because what is the percentage of that? And how many days is that? So 20 years, but it's not 365 because it's like shared days. So it's probably around like 5,000 days. So if you just missed the top 10 best return days, your market return drops basically in half, from 9.7 to 5.5%. If you just missed the best 10 days. If you miss the 20, it basically cuts in half again. And you can see the cycle, and it goes all the way down to, if you miss the best 40 days, you're negative. You have a negative return, and your $10,000 turns to $8,000. We can go all the way down to if you miss the best 60 days. And that's 60 days out of 5,000. And who the hell is going to get that correct? Nobody. No one's going to be in the market exactly at the right time or get out at exactly the right time. Even the people that are like paid the most in these funds, like, don't get it right. They don't get it right. The market almost always wins. 95% of people that try to beat the market on their own and do their own stuff, they lose. So why on earth would anyone try to time the market? Why would we wait until, something that we think is going to happen? And this is me speaking from experience. Like, during that COVID pandemic, to be honest with you, like, there wasn't a lot to do, right? So I was sitting at home and I was trying to make money from like stocks, because I thought I knew what was going to happen. I was watching CNBC, and I was figuring everything out, and I would buy into, this is so stupid, I wouldn't recommend this, buy into individual stocks that I thought were going to go up in like a week or two based on information that I heard. But guess what? It was public information, so everyone thought this and knew this. And I bought it, and they all went down. Every time I tried something, they just went down. I had no idea what I was doing. And that's what I was like, okay, I got to quit this, and I just do something that is a bit safer, and I don't need to have any information to succeed. In these other aspects of trying to time the market or time a stock, you have to have information, and most of us just don't have it, and that's fine. Many people get very wealthy just from simply investing into broad market index funds. And just to show you what this could look like visually, so let's just say we had that initial deposit of $10,000, 20 years of growth. I'm going to put in just a 10% rate of return, because that was the first sort of column there, was 9.7, whatever. And let's just say you're investing $500 a month. Okay, so that would give you a $450,000 return. Okay, pretty cool. Now, what would happen if that return went to, what was the next number? 5.5%. You're down $300,000. You just lost $300,000 because you tried to time the market and you missed, what was it, the top 10 days or something like that. And you can just keep going down. Like, obviously, you know what's going to happen. It's just going to keep getting worse and worse and worse. And I can't do negatives on here to show that, but you would understand how that would work as well. Now, I want to be super clear. When I say the stock market isn't as risky as people think, I'm not saying to buy whatever stock is trending on TikTok or Reddit or something like that. And I'm definitely not saying to put your retirement into like one company. I'm not saying you can't lose money. Like, investing is still a risk, right? Individual stocks, for example, can go absolutely to zero. Companies can fail. Investments can permanently lose value. But that's why diversification matters. And that's why I've just set up a simple 2-fund ETF in our portfolio, and that's all I've done, and that I haven't touched it. And when I'm talking about the historical recovery of the stock market, I'm talking about those broad diversified markets. Basically, I'm investing in, I use Vanguard. This is not financial advice, but I prefer Vanguard. At the time when I was, opening up all these accounts, Vanguard's kind of had the best when I weighed all the pros and cons. And to be honest, it's kind of, there's a lot of friction to like change platforms. So I haven't really done any more research in terms of like, maybe things have changed, but I use Vanguard. It's one of the top ones, so I'm perfectly happy with it. I just have a collection of the US stock market and international markets. That's it. 2 funds, bada bing, bada boom. But for long-term investors, these broad index funds are one of the simplest ways just to start participating in that growth. And here's something actually that is more interesting that I want parents to think about. And I'd love to hear from you guys. Do you have a 401k? Let me know down in the comments. And then how long have you had that 401k for? Because if you have a 401k, you're already investing. I get this question a lot, actually. And they're like, oh man, I'm behind in my retirement. I haven't even started my retirement. And I was like, oh, I thought you mentioned you had a 401k. Like, yeah, like that's investing. That's investing because every paycheck, you're literally contributing money into your investing accounts, right? The market goes up, the market goes down, you keep contributing. And it's really called dollar cost averaging, where you're just putting the same amount of money. For example, let's assume that you're putting the same amount in like every paycheck. So every 2 weeks, you're putting the same amount in, the dollar cost averaging. And I can guarantee you, you're not looking at the 401k account that closely. I don't think most people really do. It's sort of a set it and forget it, which is the mindset that we want when we're talking about long-term investing. And that's actually a pretty powerful system. Like, you already built the habit of doing that, meaning contributing. And you don't realize it because it comes before your paycheck, right? So a lot of people just forget that they have it. And the best part about this is, like, you don't have to be that crazy person like I was watching, say, CNBC during lockdown, right? You don't have to predict what the government's doing or what the top company stocks are doing and all their like quarterly reports and stuff like that. You just need a strategy that you can stick with when the market is boring, and especially when the market is terrifying. So when the market's boring, it's just like you want to change things up. It's like, oh, this is boring, but we want to get to boring. Boring is great, especially when you're trying to build wealth. So the stock market isn't necessarily risky just because it goes down. That's what markets do. It's just sort of a valuation flux, right? It's not necessarily a good thing or a bad thing. The bigger risk is for a long-term investor to never be participating in the growth at all, or even worse, as we just saw by the data, trying to time the good times and the bad times. Your job is not to predict every crash or like the best day ever, new records, right? It's just to contribute consistently over time, month over month, week over week, whatever your sort of cadence is, and give it enough time to work. And that's how my wife and I, we paid off $43,000 worth of debt because we were consistent. And then we moved that money, rolled it over into investing. And in those 3 to 5 years, that's looking back, like that's the period where like we planted so many seeds and now they're blossoming and it's pretty great. But we were so consistent. We paid off the debt and we just rolled it right into investing for us. And now we have 2 kids and we're investing for them. So if any of this is resonating with you and you feel like you're stuck on the sidelines or you don't know how to start or where to start, you have a bunch of savings maybe and you just don't know where to get the money going to start building your wealth, make sure to click the link below this video to book a call with me. See if you're a fit for the Wealthy Parent Program. We can just have a quick, friendly conversation, get to know each other, and hopefully I'll see you there. If not, you can check out this video right over here.